Ashwini Agarwal joins us now. Let's take our conversation forward and let's understand that what his opinion of the market is. So Ashwini, so far so good. A party which started just before Diwali looks like has got some more legs left.
Yes. Hi, Nikunj. Thank you for having me on your channel. I agree with you. I think the party looks to continue for the simple reason that, market's been climbing a wall of worry. And if we turn the clock back a couple of months, the worry was on the interest rate environment, on inflation and slower growth. And suddenly the narrative seems to have changed that inflation is moderating. Interest rates have come off in the US if 10-year government bond yields are to be observed. And now there's a narrative building up that US might actually be heading for a soft landing, which was seen as a very difficult outcome. So a lot of money that was kind of waiting for a correction is now being forced back in. That's how I see it. Earnings season has been reasonably good. So those are the drivers for the market. So that's what's driving things right now. Having said this, one also has to be cognizant that there are accidents possible given the rate increase that we've seen in the US over the last 2 years and the massive shift in interest rates environment compared to almost 20 or 30 years of very low interest rates and 0 to negative real interest rates. So now you have real interest rates in the positive territory. Does any accident come out of that, event come out of that? We don't know. And then you have the elections results next week, which or later this week on Sunday, which will again probably shape, some of the sentiment in the short run.
Yeah, but you think it could lead to a big shake-off, Ashwini? The exit polls are today, and of course you'll have the results come in on Sunday for the state elections. Is the market already not penciling in a complete majority by the current ruling party?
So I see you're right. To some degree, the market is kind of ignoring the elections, which is always a very dangerous thing to do. And you may be right that the market is, kind of discounting a good outcome for the BJP, and that may or may not happen. So yes, that's an issue. But having said that, even if there is a little bit of a shake-up, I think. History tells us that state elections and central elections are very different things. So to extrapolate what happens at the state level as an outcome for the general elections middle of next year might be a mistake. So I think, even if there is a little bit of a sentiment hit, market will want to move on. Unless there are read-throughs which suggest that this is not just the states, but it has something to do with the center as well. So we'll see how that narrative shapes up. But state elections and central elections are different. That's what voters have told us over the last 15 years or so. So that narrative might continue to stay.
Ashwini, I was looking at data in the morning that the market cap to GDP of India is at par with each other. And every time it has crossed 1 or 1.1, it has always led to selling or unwinding. This is a Buffett indicator I'm talking about, very old school. And in this right now, large cap stocks have not rallied. Everyone is saying large cap stocks will rally further. So I'm just confused. I mean, if the market cap to GDP is already higher and large cap stocks have not rallied, then what happens?
So great question. I was also debating about this, and then I went back and looked at the long-term Nifty PE multiple, and where does the +1 standard deviation, -1 standard deviation number stay? I was looking at a Motilal Oswal research report, which pegged, if I remember right, the EPS for Nifty for March 25 at 1140 or something like that. And if you multiply that by 19 times, which is the +1 standard deviation number, which Nifty has often done in the past, then 1 year from now, the Nifty should be at something like 22,000 levels. So, give or take 8-9% upside from here. So you're right, even on earnings basis, the upside is not significant from here. And on that Buffett indicator of market cap to GDP, you're again, at pretty much a peak. But this market cap to GDP is also a misnomer in my view, because large parts of the GDP are not listed. So how do you correlate market cap to GDP? I mean, what sense does that make? I mean, our agriculture is doesn't trade, which is a large part of the GDP. A large part of the SME sector doesn't trade. A large part of government services, which make up the GDP, don't trade. So I don't know, whether market cap to GDP is a good indicator anyway.
Ashwini, hi. Wanted to also get in your take as to what the outlook is when it comes to the overall earnings growth. Where is it that you believe that within individual sectors in India, there's strong scope of earnings growth?
I think, if you drill down on the sector side, first of all, let me take a step back. I think one point I'd like to make is that the world at large will grow slower going ahead than it has done over the last 12 to 18 months. That's my base case. I could be wrong, but that's my base case. And following with that base case, my sense is that the Indian real GDP growth will be in the vicinity of about 6%, give or take. You add inflation to that, 11%, and you add another 1 or 2 percentage points to that, you can expect broad market earnings growth to be in the region of 12 to 13%, maybe 14%. Now, within that, obviously, there'll be leaders and laggards, right? And the question you're asking me is, who are the leaders? My sense is that everybody that had a headwind over the last 3 or 4 years will probably do better in the next 2 to 3 years. So, pharmaceuticals, we are already seeing an earnings turnaround there. Automobile stocks, for 4 years, automobile sales have barely grown. We are seeing very strong demand for cars, a revival in demand for two-wheelers is visible in the holiday season sales, Diwali season sales. So maybe that's an area where we can look for some rebound in earnings. Downstream chemicals, people who were hit by high input costs and by high transportation costs is another area where I'm looking at earnings normalization. And so those are three areas that I can think of at the top of my head. IT, I've been looking for a turnaround there in earnings, but I haven't found any data points on which I can hang that thesis more firmly. So I'll stay away from recommending that as a candidate for earnings turnaround or leading an earnings recovery.
Ashwini, while that is an earnings-led view, where is it that you see pockets of exuberance in the markets, if any?
Oh, well, that's a good one. There are lots of pockets. I mean, a whole bunch of defense-related stocks, railway-related stocks. Some of the consumer names continue to be reasonably expensive. A lot of the small caps are now getting into very expensive territory. So there are a lot of pockets of exuberance. I mean, my simple philosophy over the last 30 years of investing and having made my share of mistakes is that you have to look at trailing earnings and PE multiples. I mean, everything is a cycle most of the time. For 80-90% of the stock, the cycle applies. And if there are stocks that are trading well above their +1 standard deviation on a PE basis, EV to EBITDA, price to book, price to sales, whatever number, that appeals to you basis that business. If they're trading at +1 standard deviation or higher, on the historical basis, not forecast, mind you, then you have to be very careful and you have to make a base assumption that this is a bubble. And then, look for reasons why you still don't want to accept that as a bubble. So, if you look at stocks with that lens, there are a lot of pockets of exuberance, honestly.
Example, I mean, when you say exuberance, will consumer staples qualify the cut? They may be expensive, but they are great companies.
They are great companies, but Nikunj, you've been around, I've been around, right? Let's go back. In 2000, I still remember levers was trading at whatever, 45 or 50 times. It made you no money till 2008, okay? Between 2011 and 2021 or so, it beat the market by a very, very wide margin. And while the earnings growth was more or less similar as the previous decade, the valuation multiples went through the roof. So I think, stock price performance is a function of not just earnings growth, but what valuations you're paying upfront. So a lot of the consumer names have entered the current cycle at a very high valuation multiple, and that valuation multiple may take some time to correct. Now, when does that correction get over? I can't say. Typically, you have excesses at both ends. When the valuations getting built up, you end up with an excess, and when valuations are getting derated, you get an excess. So is that excess already done? I don't think so, but that's my view. So I don't think the earnings of levers or the quality of consumer companies is poor or the business environment is poor. No, not at all. They will continue to grow very well. But I think the valuations that you're paying for them might still be a little punchy.
Are you fully invested, Ashwini, in this market in the family office money which you manage?
I mean, I'm always around 80 to 90% invested. Very rarely do I go below that. And I'm talking about my equity allocation. So there's a fixed income component. So I'm very disciplined about asset allocation, and I think that most of your viewers should look at their asset allocation very well and very closely. So there's a fixed income component and there's an equity component. In the equity component, I'm usually 80 to 90% invested, which is where I am right now. I mean, there are very few times I have gone well below this number or much higher than this number. So I'm pretty much where I normally am.
Fixed income.
Hello?
No, what are you buying in fixed income? Are you looking at buying REITs?
Oh.
Are you looking at buying corporate debt? Where are you investing this?
Sorry, I didn't hear that question. So in fixed income, there is a combination. So there are government bond funds at the longer end because I think that over the next 2 to 3 years, yields might correct a little bit. So you'll pick up not just the yield, but you'll pick up some capital gains. There is a section which is in REITs, which have got very badly derated over the last 2 years or so, and I think the current yield on a post-tax basis is very interesting, and they're all trading at discounts to their NAV, at least the real estate ones. And there, one can expect some appreciation. Due disclosure, I own the REITs, so if I'm recommending them, investors should take note that I have a vested interest in saying so. And then there is, another portion of the fixed income portfolio relates to NCDs, some structured products, etc., etc. So overall, trying to make sure that I get a reasonable yield on my fixed income portfolio.
Ashwini, thank you for joining in and sharing with us your outlook on the markets. Good to have you on board.
You're welcome.
So yes.